So hello everyone. Welcome to day two, part two of our futures trading workshop, where we are going to be breaking down and teaching you how to trade any market condition, right? So last time we had talked about a very basic introduction of the futures market, understanding what real risks, notional value, and a lot of different things are in the futures market to get you better prepared for what it is you're entering in, right? You have to know the asset extremely well before you get active in the market, right? Understanding the risk is a huge component of trading, day trading, swing trading, investing, whatever the case is, because that capital must be preserved and protected. And one of the best ways is to understand how the risk actually works. So why don't we dive into this? I hope everyone had an amazing day in our live trading room this morning, right? It was a pretty solid day overall, right? We had a very good idea, some execution mishaps on my end, but overall we found the shifts in the market pretty well. So if you guys were excited about that, had a good time in the live trading room today, we will be doing it tomorrow again in the morning, so remember to join us then. I just want to break down again what it is we'll be doing here. So we've already gone through day one in this 5 consecutive day course. Day two today, what we're going to be talking about is the futures market and participant psychology. So the general premise of this, the breakdown of day two, is going to be how big money players actually have an influence on the market, how to find them, how to understand what their stops look like, so on and so forth, to understand what the market is telling you in terms of direction and movement. So that's a very basic concept that, again, we have to understand before we start diving into profiles, order flow, all that good stuff. So again, what's our goal throughout all these 5 days? What is our goal? Is to navigate any market condition in the futures market, right? Using equity futures, regardless of the volume, volatility, all that stuff, regardless of the movement. Yesterday, someone in the Q&A that was watching this asked me, hey, how have you guys been doing throughout these market conditions, right? He mentioned that over the last few months, even, he's only seen a handful, very few amount of days that were of good opportunity. For example, one of the days was a very big trend day to the upside, and he found that as a very good opportunity in comparison to days that might have been choppy and sideways. Well, this is exactly what I want to do, right? These choppy, slow days are still opportunistic days, and I want to prove that to you throughout these 5 consecutive days of this workshop. So who is this for, right? If you're new to trading, if you've been trading for a while without too much success, if you're unsure of how to trade lower volatility, lower volume markets, right? If you've been jumping from strategy to strategy, you feel like it's impossible to trade these markets, and if you're ready to read the market like a desk trader, this is going to be for you. In this workshop, I'm going to show you the best tools step by step to understand why futures markets move, based on big market participant orders, so that you can trade any market conditions. I'm also going to be showing you those 3 rules that stay consistent regardless of what happens in the market, in the futures market, and that's what I broke down yesterday. Remember, we mainly focused on volume. So my promise to you is throughout this workshop, I'm going to show you 3 very simple tools that you can apply in any futures market regardless of the market conditions, and a step-by-step system to create self-confidence in how you trade the markets, regardless of how fast or slow these markets move. Volume volatility shouldn't necessarily matter as long as we have an understanding of why and how these markets move, so we can develop patience in our trades and our moves. So if you hear me out, stay until the end, and I'll surprise you with another little bonus gift. So in today's agenda, day 2, I'm going to be talking about how do market participants move markets. I'm going to be going through following big orders in the markets, and I'm going to talk a little introduction about auction theory and distribution theory. So today we're going to be breaking down just the basic concepts, right? The theory behind market moves, why they happen and how they happen. Then we're going to conclude and what to expect next. We're going to follow it up with a little Q&A. So if you guys are eager to ask questions, paste them in the Q&A portion, not the chat, please, because that's where I'll be taking a look at them. I can't siphon through all these chats, even though I would like to, because this might be 30 minutes, 45 minutes, whatever the case is. So how do market participants move the market, right? How do they move the market? The market is a two-way auction that we have to understand, right? Where buyers and sellers meet together, not me, meet together, pulling and pushing market movement. So there's two types of traders in the market. Very general concept, right? A big generalization of the traders that are present in the market, right? There's big money, right? Institutional or large account traders, and there is retail traders, right? So big money or large accounts that have the capacity to actually move size and move the markets are the ones that dictate where inflection points are, where large moves are, right? Because if Jimmy from Goldman Sachs or JP Morgan decides he has to offload 3,000 lots on the minis, on the SPOOs, well, us, the little baby trader in the corner over here, is going to have a pretty hard time fighting such a big order, right? So these two types of traders can be subdivided into a further category, and we can divide these into strong-handed traders and weak-handed traders, right? You don't necessarily put retail traders in the weak-handed traders category, right? They could be just smaller size institutional traders. And these traders are going to be deciding movers in the market. We'll uncover these more as we move into distributions, profiles, and whatnot, which we'll be talking about mainly tomorrow, but we'll get a little background going on this. So strong-handed traders, right? These players are patient. They wait for the key levels that they want to initiate size. They have areas where they're interested in, and they want to get active only at those areas, and those result in very large moves. When you see a strong-handed trader in the market, newer traders, people who aren't immersed in the markets, who don't watch them every day, you'll see a very, very large move after the fact when these strong-handed traders have already played their hand. So for example, yesterday, right, huge move off the mid 70s yesterday until the close. That is an area where the strong-handed buyers were activated. They were waiting for that area. They throw on large size and overwhelm when entering, causing a large move. So weak-handed traders, right? These players are smaller size traders. They still can be big money realistically. They move the markets through distributions, areas that aren't the highest probability to trade. So big clusters of volume. Weak-handed traders, they can get active in these areas, and they can move markets. They can move them like large points, right? 20, 30 points at a time. But those moves aren't going to necessarily last, right? Weak-handed traders enter markets after strong-handed traders. When the strong-handed traders have decided to throw on size and decide to create the move, the weak-handed traders do jump on board. And by the time the trend ends, the only one that's left, right? The only one out of these two that's left is the weak-handed trader, where the strong-handed traders have already done what they have to do, and they're going to reposition at a different level. So before we understand these players, right, where to find them, how to find them, what to look for, we have to understand how the market moves. The market moves in two general market structure patterns, price action patterns, quote unquote, call them what you will. And these are going to be compressions and expansions. Compressions and expansions are the only two major mass categories of how the market moves around, right? Up, down, whatever. So let's break down these principles of compression and expansion, because when we understand this, we're going to understand how the market moves, why the market moves, and we're going to start to get hints at where strong-handed traders are versus weak-handed traders. So understanding this is very pivotal to understanding market structure, price action, and just general market movement. Market moves in waves of volatility, expanding and contracting, right? Contractions are, again, another word for compressions. Expansions, expanding, right? You can piece them together, meaning that markets are generally cyclical. So they move from periods of consolidation to periods of movement. And periods of consolidation, contractions, compressions, right? Multiple different names for this. This is a range movement, right, of a contract before the explosion to a trend. The explosion to a trend is known as an expansionary period. So these periods are created by comfort in the current price. In a compressive period, prices are very, very homey, right? They're bundled up at home in the warmth, and they trade as if there's no new information entering the market. If there's no new information entering the market's going to trade sideways. It's going to be compressive. It's going to be very at home. It's going to be very at ease. And these compressions, they don't necessarily have a rule of thumb, right, in terms of a point size range. Rather, it creates balance of price, right? Meaning it creates balance in volume profiles or distributions. Again, we're leaning into something that we're going to learn in the coming days. So for example, in the red box, you see a compressive period. There's no set amount of points that this compressive period has to be, but you'll see is a sideways range, right? Sometimes escaping barely until we get this larger expansionary move. You can see what the volume profile here looks like, right? Little foreshadowing what the volume profile here looks like, and it's a belly, it's a distribution block. This is what's created. So market compressions can be seen on a wider scale as well. If we look at TradingView, for example, or we can look at an intraday basis, we can see the larger overall compressions, or we can see tighter compressions. So it's important to understand which are you trading and when, right? When are you trading compressions? When are you trading expansions? The large contracts have large breaks, right? So the image in the prior slides was an intraday compression, for example. Now, when we look at TradingView here, this is an hourly chart on TradingView. The compressive periods that we've located here are based on the distributions that you see on the sides, right? If you're not too sure about what distributions are, don't worry, tomorrow we're going to be covering that. But you can see that these ranges, right, although you do peek your head, generally, if you take a look at a wider scale, these large ranges, they can be 150, they can be 50 points, right? These are massive, massive areas. The larger the compression, and the more there is no new information entering the market, the larger the expansion afterwards, right? Compressions into expansions, expansions into compressions, so on and so forth. So when we talk about expansions, right, this is the break of a contraction period where we can get a trend into a new area or a prior value area. So when expansions occur, they run until they find another home, right? For example, like a compressive period, if we think of like comfort, right? You're at home, right? Everything's good. At some point, let's say it's stormy outside, that's the expansionary period. You're trying to get from point A to point B as fast as you can to find a new home. So when expansions happen, they tend to stall out at prior large compressions, or they find their own compressive period and they create their own compressive period. So this is the trade that you want to be a part of. The expansionary trade is the trade that you want to be a part of, especially when you have a thin contraction. A lot of traders do get beat up in ranges and low volatility areas unless they know how to play them. Playing a compression is playing either end of that compression. It's not playing in the middle of the compression. And that's why it's important to understand where and how to find the compressions. Otherwise, right, the expansion is the trade that most traders want to be a part of. This is the expansionary period, the long move that happens. And a lot of people do miss these moves when they don't understand the shift between compressions and expansions. Because a lot of people might think, hey, okay, well, we're at the top of this compression, right? I'm going to start shorting this. Next thing you know, the expansionary move happens and you keep shorting a 40-point rally, right? And this is what I want to discern, how to break down how we know which of these is going to happen. So in ranges, the majority of the time traders are getting trapped, right? They're getting beat up, they're taking losses. And when this happens, right, in these situations, new information enters the market and a new value begins to be created. So once traders break out from one direction or another, the trapped traders are forced to cover. This is the premise of the expansionary period. So just like compression, expansions can be more intraday or like minute by minute, and they can be very large expansions as well. They're created by days and days of traders getting trapped. The ideal compressive period is a multi-day compression that results in a very, very large expansion. So for example, this is an intraday compressive period here, very similar to the one, or it's the exact same one that we had showed for the compression. And you finally leap above that compressive period and you get this expansionary move, right? If I just take a look, it starts at around 85 and it runs up to 4,000. So a 15-point move on that expansion, which is, it's a decent run. And then you can have these large compressions that last a multitude of days, eventually getting this expansionary period. In this case, right, the compressive period is about 200 points wide, and the expansionary move is about 120 points long. So finding these areas and understanding how they actually shape up is a huge key in being able to trade any market condition, because in slower market conditions, you can anticipate that, okay, we're in a compressive period, right? Like the last few days have been compressive. How is the expansionary period gonna happen? How is it gonna progress, right? Where is it gonna happen? And when you start to understand these concepts, regardless of the market condition, you're able to trade based on compressions and expansions, right? If it's a large compression, trade the edge of the compression, right? As we've been doing with the compressive period in May. If it's a large expansion like last Friday or even like the last few days, trade that expansion. So this is the idea, right? With my scribbles on the screen, this is Sierra chart, and this is the compressive period that we were talking about, right? And this was last week. And we caught this trend day last Friday extremely well. So you get a compressive period that's shaping up in this large volume profile distribution. When price opens above that area, the idea is a pullback to hold the top of the compressive period for the rebid to continue. And you can see where the expectations for those prices are to hold once we start deep diving into these charts, right? For example, when you see a lot of volume at a certain area, that volume is expected to hold for that expansionary period. If you open below the compressive period, right, you're going to get the expansion to the downside. Now, within these multitude of days, even though we slightly broke through the downside of that compressive period, every single one of these days closed within that compression, except, meaning if they close within that compression, the next day open within that compression. And I don't mean day, I mean session by session, except that Friday morning that opened above the compressive period, that started the expansionary rally. So let's talk more about big traders, big trader location, because this ties extremely well into compressive and expansionary periods. Because strong-handed buyers and sellers, they get active at very specific areas. The premise of compression and expansions translates to distribution theory and how markets move from balance to imbalance. Distribution theory, balances and imbalances are just different terms for compressions and expansions. A balance is a compression, an imbalance is an expansion. Strong-handed traders are going to trade at the extremes of balances, right? Whether it's out the outside of a balance or the inside of a balance, strong-handed traders trade at the extremes of balances because those are the ledges that are created by distributions, and that's where they get active because volume thins out and they have the ability to reject or accept price very easily with their large quantities of contracts. So when looking at market structure, right, we have to understand where we stand. To do this, it's best to look for contractions and where we can get the potential expansion. It can be done in two overall ways. The first is a daily range contraction. The second is identifying stop zones, right? So let's break this down a little more. Daily range contractions, the premise of this is we start with a daily chart and we look for sideways movements on a daily basis that can lead for an expansion and a break. Because again, we have to understand that we are intraday day traders, right? We look for those smaller intraday moves that can be found on the basis of large sideways moves, right? Meaning day-to-day basis. So inside days, these are daily candles whose succeeding candle is within the preceding candle. So for example, let's say yesterday's candle looks like this. I'll draw it on the screen so we can understand what's going on. So let's say yesterday's candle looks like this. If today's candle looks like this, it's an inside day of the prior candle. The highs and lows of today's candle have to be within the highs and lows of the prior day's candle, right? These can be used for intraday breakouts. So double inside days, these are 2 days within the preceding candle. So let's say today and yesterday are both within the prior day's candle highs and lows. And these can create a very, very large break because again, these are very large compressive periods. So if we take a look at this, right, this red arrow here is the inside day candle where the highs and lows are within the prior day candle. And if you take the tops and the bottoms of that candle, right, the break through the top or the bottom is what can be known as expansionary period, right, based on a daily contraction, right? Obviously, multiple days in a row would ideally be better, but if we zoom into it, right, we break, we retest it, we hold that low, and we get that continuation to the downside, which prompts the expansion, right? Strong-handed traders, you can see, are active at the tops, they're active at the bottoms. And then when we finally do break that area, we get that downshift momentum. When we talk about stop zones, right? Stop zones is another way to identify where these expansionary moves can happen, because when you run stops, especially very large institutional stops, you're going to get a very, very big expansionary period. Now, stop hunts can be seen as expansionary moves outside of compression realistically, because if you're shorting the tops and buying the bottoms of a compression, the break through either end of those is going to expand, right? That's going to run the stops. The stop zone is clearly defined as an area where the big buyers and big sellers are known to be wrong. They know they're wrong, right? So here are a few ways we can define them. We can find major swing highs and lows naturally. We can find cascading of stops, right? And one-time framing. So what do these mean? Major swing highs and lows, this is the most basic concept realistically. We want to take note of market swing highs and lows on a daily basis. They can help traders identify not only what the current trend of the market is, but also where the large traders are hiding their stops. To create such impulses, the market must have large orders to reject the price, right? So the more wicks and days that create the swing highs and lows, the more stops might have been accumulated under or above these areas. So for example, like if we take this daily chart on the S&P 500 the minis, you can see this is a swing high, you have a swing low here, you have another swing low, this is swing high. So above this swing high, you're expected to get an expansionary period, so on and so forth, right? The more you rotate, the larger the break is going to be. Now notice, right, we have distribution blocks, right, that are present that allow us to find where these compressive periods are, right? Not to get ahead of ourselves, we're going to be talking a lot about distributions tomorrow. Cascading of stops is the idea that large stops are hidden below key swing lows and above key swing highs. So if you can draw a trend line, you can better visualize these. Like trend lines for me, they're not a trading tool, they're a visualization tool, and just in case you might be confused. But if we throw in a trend line like this, right, we can see naturally higher highs and higher lows. Sorry, higher highs and higher lows, right? So let's go into this. Imagine this before we show examples, right? You have an uptrend. The first swing low, the buyers are going to have to get into that low, right? Let's say the first swing low, you have a massive amount of buyers that are coming in. Those buyers, number one, they create the swing low. Number two, they throw their stops below that swing low to protect themselves, right? And then you get a run to the upside, and then it pulls back, and then you have a higher swing low. So that next swing low is to be higher, right? The original buyers that entered in the first swing low, what they're doing is they might be adding into the position, or new buyers are adding to the position, but they're moving their stops now under that swing low. So there's a progressive increase on the swing lows, that increase of stops. So what does this look like? They continue, so on and so on and so on. Eventually, as we get higher swing lows, there will be more and more stops accumulated below those lows. Thicker and thicker areas of stops to be accumulated. And when that flush happens, that's going to be a very large extension lower, right? You're going to see the accumulation of distributions as that happens. So here, for example, let's visualize this. In the first swing low here, you have a small box where there's a smaller amount of stops. You get a rip, you get a pullback, you get another rip. That box of stops gets bigger, bigger, and bigger eventually. And you can see under that distribution is that biggest orange box of stops, with the expectation that you're going to get a sweep to the downside, right? So this is the pullback. This is where new stops accumulate, right? This is where old stops are. So what does this tell us? Daily range contractions inside days can be found at tops or bottoms of the market, right? Swing highs and swing lows. Even if not, they create really good areas for intraday trading when we escape those ranges. So mark the inside day highs and lows and look for a break and retest. That's a very basic starting strategy for compressions and expansions. Stop zone identification, whether it's a swing high or swing low with inside days or not, you can find cascading stop areas and fish out buy stops or sell stops for more of an expansionary move, where you will want to hunt the larger move instead of getting trapped in these contractions, right? Because contractionary periods, like I said, it's an area, if you think of a contraction as a balance and you're not new to volume profiles. If you are, don't worry, we're going to talk about volume profiles, but if you're not new to volume profiles, a quick little tangent, you know that the balanced area of a volume profile is the thickest area of volume where price has a lot of volume. When price is trading in an area with a lot of volume, price is very, very choppy. That's why we trade ledges and extremes. So daily range contractions, you can see obviously multiple days of just sideways rotation where you find highs and lows for those expansionary periods. This looks a little confusing here, but that's why we're going to be introducing volume profiles that break down these distributions much clearer so we can identify where those expansionary and contractionary moves are. So you can see here, for example, the compressive period, the strong-handed sellers come in at the top, strong-handed buyers come in at the bottom. You peak out of it, temporary expansion, you come back in. When you come back into the balance, you sustain that balance, right? And then this is the example from the prior swing highs and swing lows. Remember, stops here like this, maybe like this, they increase, and eventually we get the break of those areas and we get that stop run, right? We get through the distribution, we run the stops to the downside, and we can come back within that distribution. So prices always want to find the volume home, right? Where the big volume lies, that's what's considered home. Here's an intraday chart of the same, right? You get that expansionary move and you run the stops. Look how well the stops are run, right? Strong-handed sellers, strong-handed sellers, strong-handed buyers tried to sustain this multiple times. Eventually their stops got hunted, and that is the expansionary move. So our main goal is to identify where the compressions turn into expansions. This is where the large moves happen in the market and where you can find the strong-handed traders get active, right? Even in compressions, you can find strong-handed traders get active. You can find strong-handed traders get active theoretically in compressions and expansions, right? You just have to be aware of where those areas are. So from balance to balance, and this is the essence of distribution theory. So we're going to keep building on this as this workshop continues. This is a very basic understanding of how these market participants get active in the market. When we build on this, you're going to be like, oh my God, I can see it, right? Aha, there are the compressions, there are the expansions. This is why distribution theory works. These are the volume profiles, so on and so forth, where you can start building up the confidence to anticipate moves, right? As you get information from prior days. So let's continue. So real live example, this was from yesterday. We're outside a major distribution under 4210. Right? 4210 is the start of a major distribution to the upside. So we're outside of that, meaning that we're going to be hunting a distribution to the downside. We're in an expansionary period. This is the trade plan that I laid out for our team yesterday. So we should theoretically be looking for sellers to come out at 98 to 4200 in that area. That's the first sell area. The second sell area for the strong-handed sellers to actually sustain this expansionary move is going to be 4208 to 10, right? The target, the next distribution to the downside is the mid 70s, right? I want to see price close to 72 to 82. That's the distribution start to the downside. That is the ledge that stalls out price from entering into a new compressive period. So that's where the strong-handed buyers would be expected to hold so they don't enter into that new compressive period. They've tagged it, they've seen balance. Now, if price is going to continue in the direction of the trend, they're going to reject it. The expectation is for the strong-handed buyers to show up, right? Leaning a touch bearish and on a pop and drop today. We'll see how the market opens with the orders. Yesterday, there was a much strong offer than the bid. So the overnight, I want to see the same kind of repeat where we could look for the longs in the mid 70s. But until then, we want to be short into that area. So this is the reality of trading, right? You're not always going to be perfect. These are all the trades that I had set up with our team yesterday. And realistically, you're not going to be perfect. You're never going to be perfect, right? This was the idea. We had a strong idea, but sometimes it doesn't work out to an exact T. First trade, this was pre-market, the long 41.95, right? But The first real trade of the day based on the market open, right, starts here. Oops. Starts right here and down. So the first idea, right, we want to short that 99.4200. We get a decent 6-point move. It doesn't really break the lows. It pulls back into the area. I'm shorting the same level instead of watching that area. We only go up to like 4204. So not that much above the area before we get this large expansionary move. So I missed out on the majority of the short there, right? And I was looking to try to pick up the longs where the strong-handed buyers were expected to come out. So a few of these were a little order flow plays, but then finally into 75, that area where prices were expected to hold out based on strong-hand market participants, based on the volume profile that we've seen, right? This is where we wanted to see it, and this is where we got that large expansionary move. So even if you do take a few little paper cuts, right, you'll eventually find that big move if you know what you're looking for, you know how the market's reacting. So a few of these were based on order flow. We're going to obviously go through order flow as well, but this is how it played out, right? Along the 75s, looking to close out into the 96s and the 4202s. Really strong move into the end of the day, right? Unfortunately, missed the first move to the downside by a few points, but I guess it is what it is realistically. So this is, again, the reality of trading as well. You can have a plan. The plan might be amazing. You might get pieces of the plan, but it's very understandable to not trade it exactly like a robot. So going into distribution theory, I want to introduce that to you before we end up into volume profiles tomorrow, because we have to understand the basics of this so we can just start deep diving into it and get all nitty gritty with the volume profile. Distribution theory, commonly referred as auction theory, right? Commonly referred to as just volume profile theory. It explains how the markets move from balance to imbalance, right? Markets will start at a simple area of balance, right? This is where we would consider the market to be in efficiency. Obviously, this isn't efficient market theory for investors. It's just market efficiency in terms of markets being priced in a balanced area where there's a compressive period. There's no new information entering the market. We're in a compression. And it would then require a new injection of news or some kind of new information to enter the market, which would cause an excess of supply or demand, right? Which will turn the market from balanced to imbalanced or quote unquote inefficient. This is how you generally see market moves. So if we can identify where the compressions are scattered around, we can identify when prices move from compression to compression and how they move from balance to balance. That's the core concept of just trading. You want to find where the balances and imbalances are, and I anticipate the movements of price going from one area to another. So the market would then settle into a prior balance or create its own balance, right? And then there's no new information entering the market. The cycle just continuously repeats and repeats and repeats. So remember what we know from the prior lesson. If you've seen any of our volume profile stuff, just take a look at that. It's on YouTube as well. But remember what we know from the last time, or I guess even this time. Large volume is a price attractant, right? It sustains price in this little prison or in this little home. Small, low, thin volume allows for price to pass through easily. So market distributions are bellies. They're balances in the market. These are compressive periods. Anything outside of a belly is considered imbalanced. So balance is kept by market ledges in the profile. So you see a belly, when a belly is shaped, right? I'm using my hands here. I don't know why. But when a belly is shaped, you have ledges on either end, right? The belly moves into low volume at the ends. And this is where strong-handed market participants enter the market, whether it's outside or within. This is where they enter because there's very little volume at those areas, and those are expected inflection points at those extremes. So to the right is what the market auction looks like in a quote unquote clear balance, a compression. We're going to talk about different kinds of balances, but anything outside the value area or balance area is considered imbalance or unfair. Realistically, it's an extension. And should these areas reject the target, it's going to come back within that value area or balance, which is exactly what had happened yesterday and today. We reject price from getting into the major balance. and it rides back up into its prior balance, right? So we can anticipate the movement of the market based on the information we have from volume. Should they confirm, then the exploration for new balance does begin. This is an example, right? This is from yesterday. If we add today's, we're going to see that volume comes back into the area, right? There's a little balanced area here, and you can see we're moving outside of it. This is the larger balance here. The expectations are that price moves into this area where you have these ledges, which would be expected to bounce prices back up. So we're going to be deep diving more into this chart and more about distribution theory, and volume profiles in our next class, which is tomorrow. But try to wrap your heads around how all of this actually begins in terms of market participants actually trading in the markets.